Assalamu alaikum. Welcome to lecture 18 of ATX. This is the continuation of lecture 17 where we have started with corporation tax. So in lecture 17 I have introduced you to the basic rate of corporation tax, how corporation tax are calculated, which date corporation tax are paid, and for large companies how they are paid in installments and how to calculate those installments, and the penalties, interest of paying corporation tax late. So all the administration rules, the way to calculate competition tax, the basics has been covered in lecture 17. Now here we are going to calculate in detail the calculation of corporation tax, income and gains. Now here we are going to focus on how do you compute taxable total profit. Remember, your corporation tax is calculated on taxable total profit. Therefore, you need to know how to calculate your taxable total profit. That is your TTP. Next, chargeable gain for companies. Next, we have research and development expenditure. So here onwards, we are going to study on the new areas introduced in ATX. Intangible asset is new. Expenditure that reduces tax. Transfer pricing is new. Companies with investment business is new, and summary. Wherever you can see that I've highlighted that it's new for ATX, was not there in tax. So this areas has more chance of coming in your ATX exam. So be prepared for it. So starting with the overview, we calculate the total profit. We start with the business profit. Okay, in the business profit, we have intangibles, R&D, transfer pricing, and thin capitalization. Then we have gains. We have substantial shareholding exemption. Then we have companies with investment business. Okay, so these are the areas we are going to focus on. Starting with the pro forma. Learn the pro forma of any tax. It's going to help you a lot. Saves the time. So first you write the name of the company, then you write what type of tax you're calculating, whether it's income tax, IHT, corporation, okay, and the year. AP means accounting period. Then we start with the trading profit. I have put a asterisk mark next to the trading profit. The reason is there are some notes to it later on in the next slide. Then interest income, you add property income, all the types of income you add of the company. Then income, net chargeable gain. Net chargeable gain you add after you take all your income with your trading profit. That's net chargeable gain. That means all your chargeable gain less allowable losses. Then you get the total profit. Here you deduct your QCD, which has to be the gross amount, which normally in the exam you will be given. Then you get your TTP. So from total profit, if you do not deduct QCD, you will not get taxable total profit. You will only get total profit. And so wherever I put the asterisk mark, trading profit, interest income, property income can include overseas income as well. Okay. Gross of overseas tax suffered. If you are given the net income, you have to gross it up with the overseas tax that you have suffered. Remember, gross amount has to come. Now, starting with the trading profit. So for the sole trader, what do we do? You have to adjust the net profit for the tax purpose. Okay. And capital allowances deducted. So trading profits are always dealt on an accrual basis for companies. The key differences that apply to adjusting a company's profits are this. Remember, we are in companies now. Okay. Here we have no private use adjustments, unlike in individuals. Okay. When we have gone through capital allowances computation before, now we are going to go once again for companies. The difference is for individual capital allowances, when we went through, there were private use adjustments, if you can recall your income tax. Moving on to company, we don't have private use adjustments for capital allowances. We'll see the computation in few minutes. Any interest receivable or payable for trading reasons is included in the trading profit. Okay. Any interest receivable or payable for trading purpose. See, interest receivable or payable is not a trading profit, but if it's for trading reasons, it's included in the trading profit. And if interest receivable or payable is non-trading, it is included in interest income. It's very easy. Trading, trading profit, not trading, interest income. Now, dividends payment. Dividend payable are not an allowable trading expense. That means you can't deduct from your expense. Enhanced deductions are available for R&D if conditions are satisfied. When we go to R&D, we'll see. Adjustments are required for intangible assets, transfer pricing, and then capitalization. Now, moving on to capital allowances. See, capital allowances is what we have to deduct from trading profit. Okay? The way we apply capital allowances, FYA, AIA, WDA are same like how you have done for unincorporated businesses, but with additional points. For AIA, the maximum we know for a sole trader partnership was 1 million for 12 months. Okay? It is same for the companies also. The new is for companies, AIA you can split between related companies. This was not there in the sole trader. There you only have one for each sole trader. Here between related companies you can split the AIA, split that 1 million. A group of companies will be entitled to only one AIA, only 1 million. Group of companies means where you have parent and subsidiary. They are related. So because they are related, they will only have one AIA. And group can choose how they want to allocate their single AIA among themselves. Next, a group means where you are having more than 50% shareholding in another company. If you are having less than 50%, you do not come under the group. Therefore, in examination question, which is related to capital allowances for a company within a group, you have to allocate the AIA between the group members. You have to see whether they are group related companies or not to allocate AIA. When you are allocating AIA, you can allocate the 1 million in any way. AIA does not have to be divided equally between them. Some can have 700,000, some can have 300,000, some can have, some can have 100,000 each. It's like that. There is no fixed choice. Then, even all of the allowances can be given to one company. Okay? Or any amount can be given to any number of companies within a group. There is no limit to it. You are very flexible in that. Companies owned by the same individual will be regarded as related. If you are the one, Mr. A is having 5 companies, all the 5 are related. And where they are engaged in the same individual should be engaged in the same activity or should share the same premises, they are related. If the individual run 2 companies from home, you will only get single AI and you have to allocate between them, the 2 companies. Okay? Unrelated companies will have full AIA for each companies. You can have 3 unrelated companies, you will get 3 AIA. Now, enhanced capital allowances. This is new. We didn't go through this word enhanced capital allowances. Capital allowances, yes, for sole trader. But for companies, we have ECA. Companies, this is for only for companies. Purchasing new qualifying plant and machinery between 1st April 2021 to 31st March 2023 are eligible to claim this. Remember the dates and remember what you can claim. 130%, remember the percentage, 130% deduction for assets which go into the main pool, or 50% FYA for special rate pool. 130% only if it goes to the main pool, or 50% FYA if it goes for the special rate pool. So for special rate pool, AIA would have been claimed in preference to the 50% FYA with the 50% FYA applied to the balance, if any of the expenditure. Now, a question will not be set in the exam involving an initial claim for enhanced capital. See, initially no one claims for this enhanced capital allowances. No question will be set. But you may be required to deal with the disposal of plant and machinery on which enhanced capital allowances were claimed. Next, dispose. This is the part you might be asked in the question. Disposal of assets on which ACCA were claimed. So if you're disposing an asset that qualifies for 130% super deduction, this will trigger what? Balancing charge. That will be equal to your disposal proceed. So disposal of asset that qualifies for 50% first year allowance will trigger an immediate balancing charge once again. In both cases, a balancing charge. This is calculated as this. You have to know this. Proceed, multiply your proportion of expenditure on which FY is claimed into 50%. The remaining proceed are deducted from the balance on the special rate pool before the 6% WDA is claimed. Now let us do question. Illustration 1. Here, disposal of assets on which ECAs were claimed. Calculate the maximum capital allowances they can claim for the year ended 31st March 2024. So here, accounting date is 31st March. During the year, they sold the following. Machinery for proceeds of 70,000, the cost is 90, 130,000 super deduction were claimed. Integral feature for proceed of 750, original cost is 1 million 2, AI is 1 million and 50% FI on the balance. As at 1st April 2023, the tax written down value on the main pool was 450, special rate pool was 1.7 million. So now what we have to do? The capital allowances column. Let us quickly do that. Main pool, special rate pool and allowances. Okay, now we always start with the brought forward balance. Tax written down value brought forward. So in the main pool we have 450,000 and here we have 1,700,000. Total, okay, no. Then we have disposals. First is super deduction. It will give you a balancing charge. How much? Remember, it is equal to your proceed, balancing charge. If you are having 130 super deduction, proceed will be equal to your balancing charge. So 70,000 is the charge, so it will be in bracket in the allowance column. Next, proceeds relating to 50% FYA. %50 FYA also will give you a balancing charge. Okay, but you need a working for it. So remember, you have claimed AIA. You will first claim the AIA against the special rate pool. That is the integral feature. Okay. So integral feature, the cost was 1.2 million and you have claimed all the entire 1 million. So how much is left? 1.2 million minus 1 million AIF you are claiming. Then you are left with 200,000, 0.2 million. Okay. So here you have been given a formula for 50% FYA. Balancing charge arises on the sale proceed relating to the proportion on which FYA was claimed. So what is the sale proceed? 750,000. And 50% FIA will be claimed on the balance. This is the balance after you claim the AYA. So this will be the formula. 750 is the sale proceed of integral feature, proportion of 200,000, the balance of FYA. on which you can claim. And what is it? The cost is 1.2 million of integral feature. Into 50%. This was the formula just now we studied the proportion. It is 60/500. This proportion is given in the slides. You have to know it. Okay. And the balance of the proceed will be deducted from the special rate pool. So 60/500. This is the charge. In the allowance column, it will be a deduction. Next, balance of proceed. Balance of proceed will be deducted from the special rate pool. How much? What is the proceed in the special rate pool? 750,000. So 750,000 minus 62,500. Special rate pool is the second column. So 687,500 you deduct. In the main pool you will be having 450. Special rate pool 1,500,000. Deduct the WDA. Add 18% for main rate and 6% for special rate. 81,000 and 6% will be 6750. So this is also an allowance 141,750. Tax written down value carried forward 369,000, 951,750, and allowances will be 9,250. This is the total. This will come down 9,250. This is the total allowances. Okay. Now, pro forma of capital allowances for companies. So as you can see, like how we have for sole trader, same columns we have A, IA, FYA, main pool, special rate, short life, and allowances. So we start with the brought forward balance, which goes in the main pool. If you have any brought forward balance for the main pool, then special rate, then could be for short life asset. So all the definitions of main pool, special rate, short life, I've explained to you when I've introduced capital allowances first time for the sole trader. So please, you need to go back to my lecture of the sole trader for company capital allowances for sole trader. You will get it under my ATX playlist. Okay. So I'm not going to explain the definitions and the rates once again. I'm assuming you know the knowledge of capital allowances from the sole trader and you're bringing it forward to the company. In case you forgot, you can always go back to my sole trader lecture for capital allowances. Now, additions not qualifying for AIA. Car 1 to 50 grams will go in the main pool. Car over 50 will go to special rate. Qualifying for AIA. Special rate, you first deduct from special rate because special rate is 6%, whereas main is 18%. So you deduct 1 million. So this 1 million, whatever the amount you deduct will go in the allowance column as well. Next. And the balance will go in the special rate. Then from main pool expenditure, if you have anything left to deduct the 1 million AIA, the AIA will go to the allowance and balance main pool. Then disposal. Lower of origin and sale proceed will go to the main pool or special rate, or it could be short life asset disposal, whatever the type of asset. Then you deduct your balancing charge. You will get a balancing charge for super deduction. Just now we have seen, which goes in the allowance column as a bracket because it's a deduction. Then you will get a balancing charge on proceeds relating to 50% FYA will also go in the allowance as a bracket. Then balance of proceed relating to 50% FYA in the special rate pool, and finally you start adding up the column. Main pool, special rate pool, short life. Now the total could be a balancing allowance or a charge in the short life asset. And in the allowance, it could be an allowance or a charge. If you are having a positive figure, it's an allowance. The negative figure, the figure is in bracket, it's a balancing charge. Then, if you're having in a small pool WDA, if applicable, you can deduct. Next, WDA at 18% from main pool, WDA at 6% from special rate. Both goes to allowances. And additions qualifying for FYA. Zero emission cars in the FYA column, 100% FYA will go in the allowance. And finally in the main pool the balance will be 0 because you have claimed 100% FYA for zero emission car. Now the total taxation down value carried forward. In the FYA it will be 0, then main pool, special rate, and then total allowances. We'll just have one figure. Have to add up. Okay. Next, structures and buildings allowances. Here, when a business incurs expenditure on qualifying cost for new non-residential structures and buildings or renovations or extensions to existing buildings after or on 29th November 18, you are eligible for SBA. In examination, questions will only be set where building was constructed or renovated on or after 6 April 2020. Remember, 1st April 20 for limited companies. And where relevant, the construction date will be given. That means you will be given SBA because it's after 29 October 2018. Where buildings are purchased as opposed to newly constructed, that means you're not constructing newly, you are purchasing the building, you should assume SBAs are not available unless it is stated in the question if it is purchased. And if the if the building or the structure is used for trading or property letting business, okay, but residential property like dwelling houses, they do not qualify. They do not qualify for SBA. Now, these are the qualifying costs that will be there for SBA. Any buildings including offices, retail, wholesale premises, factories, warehouse, hotels, care homes. Remember, it has to be for business purpose, commercial purpose, the buildings. Then structures, roads, walls, bridges, tunnels. Qualifying costs do not include, remember, land, legal fees, stamp duty, land tax, repairs, maintenance. They are not qualifying costs. You can't claim SBA. Here, SBAs are available on a straight line allowance of 3% on the qualifying cost. Take the cost, apply 3%. That is SBA. From the date the building is brought into the qualifying use, okay, you have to time a portion if partway through a period. Let's say it is available for 6 months. It has been brought into qualifying use. Then you have to take 6 months. There is no pooling system for assets eligible for SBA. See, we pull assets that are eligible for capital allowances, right? We put in the main pool or special rate pool. But for SBA, there is no pooling system. So, they are kept separate from other assets which qualify for capital allowances. Remember, assets that qualify for capital allowances should be kept separate from assets which qualify for SBA. Any asset eligible for SBA will not be eligible for AIA. AIA is under capital allowances. Okay, so you can only claim one. Both will not be. You can't claim both on one asset. That is, both capital allowance and SBA will not be claimed. You can't claim in one single asset. Next, disposal. When you are selling an asset, the seller claims the SBA to the date of disposal. Time portion if partway through a period. There is no balancing adjustment for the seller. The SBAs claimed to date must be added to the sale proceed for the calculation of chargeable gain or loss arising for the seller. You have to remember the steps, okay? The buyer, what happens with the buyer? Buyer takes over the remainder of the useful life and receives the 3% SBA based on the original cost of the structure or building. So now let us do a question. Test your understanding 1. So in test your understanding 1, we have to do two things. First, calculate capital allowances available for Peacock for year ended 31st December 2023 in respect of the head office. B. Explain the SBA implications on the sale of the head office to the Flamingo on 1st April 2025. Remember, wherever they say explain some implications, you have to write actually. Okay, not just merely calculations. So let us quickly first do the capital allowances. You have been given some cost. The reason is you should know on which are the qualifying cost and which are not. Okay, so here they have entered on 1st of May, entered into a contract to construct a new head office. Construction was completed on 31st October and head office was used from 1st December 2023. You have been given the land stamp duty, land tax, legal fees, construction costs and plant and machinery all new. Peacock retains plant and machinery but sells the head office to Flamingo for 1 million, including 250 for land. On 1st April 2025, Flamingo immediately starts using the head office in its trade. Both of them prepare their accounts to 31st December each year. Now, tell me. So you can claim plant and machinery. 100% AIA you can claim. On what? Plant and machinery. That is on this 100,000. So if you are taking AIA 100%, it is 100,000. Okay. AIA is 100,000. What about SBA? It is 3%. Remember, from the date the head office was used, because SBA is on the head office. You entered into the contract on 1st of May. Construction was completed on this date and head office was used from 1st of December. So from 1st of December to 31st December is just 1 month. Okay, on the construction cost. You have constructed the head office. So it's 450,000 into 3%. SB is 3%. And for how many months? You have to time a portion. It's only for 1 month. The month of December. Because head office was used from 1st of December till 31st December. So 1 month. So the SBA is 1125. Okay. Remember, only the construction cost is eligible for SBA. Land, stamp duty, land tax, legal fees, they are not eligible cost. And SBS can only be claimed from the date the asset is brought into use in the business. Now, part B, explaining the implications. When we are explaining the implications, okay, remember it is affecting two people. One is Peacock, one is Flamingo, the buyer and the seller. So you have to explain the implications to both. Okay. So first let's start with the seller. When we are selling the head office, who is the seller? Peacock. In this case, Peacock is the seller. Peacock PLC. Impact on the seller. Just now we have checked the impact on the seller and the buyer. So for him, the SBS will be available to the date of disposal. You have to write in different paragraphs when we are writing the impact. When you're explaining 2-3 impacts together, implications, each implication in one line. So first, SBS are available to the date of disposal. What is the date of disposal? They have given the date of disposal, 1st April 2025. Next, so the allowances will end by The allowances for the year ended is 31st December 2025. So we'll find the allowances for the year ended would be how much? Because they are making their accounts to 31st December each year. Okay. Take the amount of the construction. It is 450,000 multiplied by SBS 3% into how many months? Only the first 3 months. Jan, Feb and March. See on this date, first 3 months to the date of disposal. So it's Jan, Feb and March because 1st April 2025 you are disposing it. This much. Next, Peacock. See, this is a seller, so they will have a chargeable gain also. Peacock will have a chargeable gain. Okay, so this chargeable gain, how will calculate? You have to name the company always. Okay, don't just write company. You don't know which company. Always mention the name of the company given to you in the question. So Peacock PLC would have a chargeable gain because they are making a disposal, no? Would have a chargeable gain which would be calculated as you have to explain. Deduct the sale proceed. Okay, how much is the sale proceed? See, they sell the head office to Flamingo for 1 million. Okay, so you have to include this. Calculated as the sale proceed of 1 million less the cost of the, you have to deduct the cost of the from the sale proceed. Construction, legal fees. See all the expenses you have to deduct. Stamp duty, land tax. Stamp duty, land tax. So you have to deduct the land, this, and the construction cost. All this you have to deduct. 200,000 plus 450 plus 10,000 plus 1,000, which is adding up to 661,000. So you deduct 661,000 from 1 million. Okay, now the next, the total SBA's claim to date okay, will be added to the proceed when calculating the gain. So this total SBA claim to the date will be added with the chargeable gain. How much? Of, I'll leave some space for you to calculate. How much? SBA already we have calculated. Here 1125. Then first 3 months before you are selling 3375. So 1125 plus 3375 plus what? Plus you have to do a working here. Since subsequent years SBA will be just 3% on 450,000, which is 13,500. This will be your SBA in subsequent years. So 13,500. So it's 18,000. So this 18,000, okay, the total SBS claim to date of 18,000 would be added to the proceed. This SBAs that you have claimed till date you will add to the proceed when you are calculating the gain. That's it. Now we are moving on to the buyer, Flamingo. Flamingo is the buyer. So he will take over. F takes over the balance of the qualifying expenditure. Qualifying expenditure, I'm writing QE. For remaining useful life, UL. Remember, the price it pays for the office is irrelevant. Now, so how much Flamingo can claim? They of SBA can claim SBAs of 450,000 into 3%. Remember, first 3 months is for the seller. After that, the remaining 9 months is for the buyer. That is 10,125. In the year ended 31st December 2025. That is from April to December, 9 months will be claimed by the buyer. Because the building is put into use in straight from 1st of April 2025. So you have to write it. Now, in subsequent years, SBA of how much? 450 into 3%. No need to time a portion. It's for full year. It is 13,500 can be claimed. 13,500 can be claimed until the original eligible cost. is fully relieved. So here you are showing the implications with, yes, of course, some calculation you need to show the implications, like how we have calculated SBA. Next on the list after trading profit, we have interest income. So for interest income, we need to see the loan relationship rules. All income and expenses relating to borrowing or lending of money are dealt under loan relationship rules. Expenses relating to borrowing money. So these are the expenses. Any interest paid on overdraft, bank loans, corporate loan notes. Other costs like arrangement fees, incidental costs incurred in raising the loan. Write-off impaired debt arising from lending money. And loss on disposal of corporate loan. Income received from lending money. So any interest income like interest from bank deposit, interest from loan, interest on government stocks, and interest from corporate loan notes. Now, trade versus non-trade purpose. So in order to apply the loan relationship, all income and expenses that are relating to borrowing and lending, you must see whether they are for trading or non-trading purpose. Okay. So we'll see that first for the trading purpose and then for the non-trading purpose. If it's for trading purpose, what would be the income and the expenses? So the income non-applicable. We'll see note 1. And interest payable or expenses relating to. So any interest payable for a loan that is taken to purchase plant and machinery for the trade. It's known as that expense is incurred for trading purpose. That loan you have taken, that expense that you have incurred on loan is for trading purpose because you have taken the loan for what? To purchase plant and machinery for trade. Any loan taken to purchase a property used for trading purpose like office, warehouse, or a loan on an overdraft to fund daily operations, working capital, trade purpose. Loan notes to fund trading operations, and write off a trade related loan. All the interest or expenses relating to this set for trading purpose. Okay. Now, for non-trade purpose, we are going to have this type of income. Any interest receivable on bank account, interest receivable on investments such as gilts, interest receivable from HMRC, profit on disposal of corporate loan notes. We'll see note 2 and 3 later. Then, for non-trade purpose, interest payable expenses relating to where you are taking a loan to purchase a commercially let property, where the rent would be taxable as property income. Okay, not trading income, property income. Loan to acquire shares of another company. Then is for non-trade purpose. Interest payable to HMRC is for non-trade purpose. Write-off for non-trade loan. Loss on disposal of corporate loan notes. All these are non-trade purpose. Now, first note where we said that we don't have any. So, all interest received by a company is a non-trade interest. You can't have any interest received by a company and say it's for trading. It's a trade interest. It's for trading purpose. No. That's why it says non-applicable as note 1. Unless it is the company's trade to lend money. Let's say bank. What is the bank's main primary trade? Is to lend money. For them, lending money is a trade. But we are not working in the bank scenario, right? In the examination, they will not provide you that you working in a bank. You might be working in a company. That is the normal situation. Okay. Or it is interest charged on a late paid customer invoices. So that's why we don't have any income. Then second, any interest received from HMRC is taxable as interest income. Interest paid to HMRC, you can deduct as an interest income. Then for sole trader, interest received from HMRC is exempt income, and interest paid to HMRC you can't deduct from income tax purpose. This is the difference. Remember, for company, interest income will be taxable under corporation tax. Interest payable to HMRC you can deduct from the profit, the income, interest income. But for sole trader, Interest received from HMRC is an exempt income, and interest paid to HMRC you can't deduct from income tax purpose. Note 3. Disposal of a loan note is not an exempt disposal for companies, remember. But for sole trader, it is an exempt from CGT. When you're selling a qualifying corporate bond, that is QCB, qualifying corporate bond, when you're selling it, it is exempt from CGT for individuals. But for companies, it is not an exempt disposal. Next. So the tax treatment. Amounts that are for trade purpose, you will take as a part of trading profit in your TTP calculation. Such amounts must have already been included in your accounting profit. Right? No adjustments to profit is required for tax purpose. Amounts that are not for trade purpose, they are included under interest income. Okay? For the calculation of TGP, they come under the heading of non-trade loan relationship. If these amounts were included in the accounting profit, what do you have to do? Either you have to add back or you have to deduct from your profit and then show separately under interest income heading. If you're not understanding any of this, don't worry. We'll do calculations. Interest received and receivable usually credited in the company accounts on the accrual basis. Interest receivable by a company is taxed on accrual basis. So the figure included in the account is the figure that should be taxed as interest income. Now, remember, companies receive interest gross. So the amount credited in the accounts is stated gross. Most interest paid by companies is paid gross. Okay. There's an exception to this. When an interest is paid to an individual on unquoted loan notes, there it is not gross. There you have to deduct 20% of income tax from any interest paid to an individual. So the company, company has to deduct that 20% income tax. So the company must account to HMRC for this income tax. It deducts at source on behalf of the individual on a quarterly basis. Now, in the accounts of the company, interest paid and payable charged against profits will be the gross amount. Okay, whether it is paid to another company or an individual. If the non-trade expenses are more than the non-trade income, what happens? Expenses are more than income, but the non-trade, what happens? The excess is a deficit. Excess will be deficit because expenses are more than income. So excess is a deficit eligible for loss relief. Now, third type of income, overseas income. This is new. This is also included in TGP. It could be your interest from overseas or rent from overseas. Remember, dividends from overseas are excluded because all dividends received by a company are exempt from corporation tax for the purpose of ATX. Profits from overseas branch comes under trading profit unless the exemption election is made. We'll see later what is this exemption election. Overseas tax deducted must be added back to the gross income in TTB and double tax relief may be available. Now, property income. Property income calculated is the same for individual except companies always taxed on accrual basis. Companies assessed on income arising in the accounting period, not the tax year. And interest on a loan to buy a let property is treated as a deduction from interest income under the loan relationship rules, not property income. There is no restriction on the interest deduction if the company borrows to invest in residential property, but in individual there was a restriction. Losses can be relieved against other profits, not just property income. So company has more choices. Companies cannot have renter room relief nor furnish holiday accommodation. This was therefore sole trader. Now, Replacement furniture relief, okay, does not come in corporate question. Why? Because relief only applies to furnished residential property, and companies in the examination usually rent commercial properties, not residential properties like warehouse, offices, factories. Now, miscellaneous income. This is uncommon, and these are the incomes like royalties received or paid for non-trading purpose, held as investments. If it's for trade purpose, amounts are included in trade profit. If both cases, in both cases, amounts are included on accrual basis. Profits on the sale of goodwill and other intangible assets are included in this type of income if the asset is not held for trading purpose. Next, chargeable gain. Chargeable gain are calculated in the same way as for individual, but with these differences. In company, we have indexation allowance, we have rolled over relief, we have capital losses, we have annual exempt amount, shares and securities. Differences comes in these areas, these bullet points, okay? So these are the 5 areas where you are going to have differences with the individual. First, starting with QCD. So the next is QCD. All donations to charities by companies are allowable. That means you have to deduct. If it's a small local donation as a training expense, you can deduct. All other donations you can deduct from total profit. All charitable donations are paid gross. Amount paid in the accounting period is therefore allowable. If the QCDs paid exceeds the profit of the company, there is no relief for the excess. Okay? You cannot carry back or you cannot carry forward QCD unless the company is a part of a 75% group. Then you can claim group relief. Long period of accounts. Okay? Companies, okay, have to get permission from the registrar of companies if they wish to extend their periods of account more than 12 months. Period cannot exceed 18 months. So, an accounting period cannot exceed 12 months for corporation tax. Long period of account. Here, when it's exceeding 12 months, period will be split into 2 accounting periods. One is the first 12 months, other is the balance. Let's say you are preparing accounts 18 months. So, first one is 12 months, that is till year end 31st May. The next one is 6 months till 30th November. First one is always the 12 months, next is the balance. Next, profits are split between the accounting periods. So, based on the income, this is how they will allocate. Okay. If it's a tax adjusted trading profit before capital allowances, you have to adjust the profit for the long period of account in the normal way, then time apportion. First, you adjust the profit for long period of account, then you time apportion. Capital allowances. Separate computations for each accounting period. Okay. If it's short accounting period, remember, your WDA and AI will reduce. Interest and property income. Calculate the amount for each period separately. Chargeable gains according to the date of disposal. QCD according to the date paid. If information applies to the strict basis, if information to apply the strict basis is not available, time apportion. Now, so 2 separate corporation tax computations are required with 2 separate payment dates. Next topic. So we have just finished computation of TTP. Now we are moving on to the chargeable gains. The next. Chargeable gains, same way for individuals with the differences. So as I told you, 5 differences were there. First, it was indexation allowance. This was not there for individual, it's applicable for company. So we'll start with that. IA. This is available for companies for assets acquired before December 2017. This gives the allowances. Okay, this is like it's like they're taking into account the effect of inflation when they're calculating chargeable gain. So the rules is this. This is how IA is calculated. You need to know this, by the way. You will be given one question where you have to calculate indexation allowance. Is very important. Cost of the asset into indexation factor. So indexation factor is your RPI from the month of purchase to the date of disposal. Okay, or December 2017 if earlier. So IA, remember, for each expenditure, IA is calculated separately. You might have three expenditure. All the three expenditure will have three separate IA. So you will calculate different IA for the original acquisition cost and any subsequent enhancement expenditure because they have different purchase dates. See your acquisition cost, and later if you have any cost to enhance your asset, the IA will be different. Indexation allowance will be different because their purchase dates of two costs are different. Remember, indexation allowance you cannot use to create or increase your capital loss. Okay. Now, indexation factor will be given to you in your ATX exam, so do not worry about the factor. Next difference was rollover relief. This is okay. This is the old relief that is available for companies. For individuals, we have so many reliefs, if you can recall. But for companies, the old capital gain relief is rolled over. This they can claim for gains on disposal of qualifying business assets, same like individual. Land and buildings used in trade, fixed plant and machinery, where proceeds are reinvested in new QBA within the time period, 12 months before disposal to 3 years after disposal. All these are same. Now, so the rule works in the same way as for individual with the exception. For companies, goodwill is not a qualifying asset. Remember, goodwill is not a qualifying asset for company. So you can't claim rollover relief for goodwill. Then, rolled over relief is applied to the gain after you deduct your indexation allowance. If all of the net proceeds from the sale of the original asset are reinvested, then whole gain may be deferred. If only part of the net proceeds are reinvested, then only some gain will be deferred. So gain that must be chargeable is equal to the lower of the gain and proceed not reinvested. Next, any gain that is deferred will be deducted from the cost of the new QBA unless that new QBA is a depreciating asset. And the time limit for claiming the relief is 4 years from the later of the end of the accounting period in which the asset is sold or replaced. Now, let us do question. Test your understanding too. You need to calculate chargeable gain for him to include in the corporation tax computation. Now, so 31st December is the date they prepare the accounts, and on 12th September sold an office building for 3.5 million. They have acquired this building on 3rd June 1999 for 700 and extension was built on 13th October 2005 costing 200. Company reinvested 1.4 of the sale proceed on 14 December purchasing a small office building for the purpose of its trade. So you have been given the indexation factor. One is for the cost, the other one is for the extension date. So now let's quickly do the chargeable gain. You start with the sale proceed. Sale proceed is 3.5 million. Okay. Now deduct the cost and enhancement expenditure. So the cost, remember, first we find the unindexed gain. Okay. And then from that we deduct the indexation allowance. Okay. So normally we just take the cost 700 and 200 and start deducting from the gain. Normally it will be 2,600,000. Now this is known as unindexed gain because we haven't deduct the indexed cost. Now from here will less indexation allowance IA So the cost and enhancement expenditure. What is the indexation factor for cost? This one. And for enhanced expenditure, this one. Looking at the date, you just multiply it. So 0.679 into 700,000. It is 475,300. You will see it will be much less than 700,000. Same goes for the next one, but indexation factor is different. 0.439 into 200,000. The date 87,800. And now it is known as indexed gain. 2,36,900. Okay. Do we have any rolled over relief? Okay, we have to see for it. Okay. So now we have to see. Company reinvested 1.4 million of the sale proceed on this date. So what was the sale proceed? 3.5. No, they have reinvested 1.4. They have not invested sufficient sale proceed in the qualifying asset. That's why rolled over relief will not be available. Okay. You see, because they have reinvested just 1.4 out of 3.5. Therefore, so we'll see how much the chargeable gain. Okay, wait. Chargeable gain will be lower off. All of the indexed gain in this case 2,36,900 or sale proceed not reinvested. One, two, whichever is lower. So sale proceed non reinvested. We have sale proceed of 3.5. We have reinvested only 1.4. So not reinvested is 2,100,000. You see, this one is lower. So that's why there is no rolled over relief, and this is your chargeable gain. Can't be 2.1 million. So this is your chargeable gain and no rolled over relief. Now, the next is capital losses. All capital losses have to be set off against gains in the same accounting period. Any net gain is chargeable as part of TTP. Net losses are carried forward against first available future net gains. Subject to restriction, capital losses cannot be offset against any other types of income, nor they can be carried back and set off against income or gains of a prior accounting period. These are the differences for capital losses for companies. Now, the following steps should be carried to compute chargeable gain to be included in company's corporation tax. First step, calculate gain and loss on the disposal of each chargeable asset separately. Then you total them, all the gains. That means all chargeable gain less capital losses. Remember, it has to be in the same accounting period. If they are different accounting periods, gains will be calculated in two different accounting periods. Then you deduct any capital losses brought forward, which will be your net chargeable gain. This you will add in the TTP. Next, annual exempt amount. Remember, for companies, there is no annual exempt amount. So the total net chargeable gain is the same that will be included in your TTP. Shares and securities. Disposal of shares is matched like this. Acquisition on the same day as disposal. Acquisition during 9 days before disposal. This is on FIFO basis. First in, first out. And acquisition from the share pool. There are some differences there with the individual. Right? Individual, we have acquisition during the following previous 30 days from the date of the disposal. Right? Step 2 was different in individual. Now, so the share pool for company is prepared as follows. The pool contains shares in the same company of the same class purchased up to 9 days before the date of disposal. Pool keeps a record of the number of shares acquired and sold, cost of the share, index cost of the shares. Remember, even shares will have index cost. Cost plus indexation allowance. When the shares are disposed out of the share pool, appropriate portion of that cost and index costs which relates to the shares disposed is calculated on an average cost basis. We'll see how. Calculation of cost and index cost in the share pool will not be asked. Matching rule and share pool are different for individuals. Remember, rolled over relief is not available for gains on disposal of shares. An exemption applies to the disposal of shares by a company out of substantial shareholding. We'll see that next. So the conditions for the exemption often apply to disposal of shares by a company in the ATX exam such that it is not necessarily to calculate a gain. That means normally exemption applies. Now let us do a question. Day as a day accusation. Do you have any? You have sold it on 12th Jan. No, you don't. Do you have in the previous 9 days? Yes, this one. Because it's on 12th Jan and this is 4th Jan. So the first you will take from 2000 and the remaining from the share pool. How many? 5000. So 2000 from 4th Jan and from share pool you will take 3000 because you have sold 5000. Okay. Now you have to calculate two gains. One from the share pool, one acquired in the last 9 days. So gain. This is 4th Jan. Gain on shares acquired in last 9 days. This is for the 4th Jan. So what is the proceed? You have sold 2000 out of 5. So 2000 out of 5000 you have sold into what is the proceed? 50,000. You have sold it for 50,000. So it's 20,000. Now let's take the cost. Cost has been given as 4,500. Entire 2000 you have taken, so 4,500. Full cost you can take. This is the chargeable CG, chargeable gain. Now gain pool. Gain on share pool. So you 50,000 from the pool. Proceed is 50,000. 30,000. Next, cost. Okay. First you take the cost, then you deduct indexation allowance. Okay. So to calculate a cost, there is a working. You need a working for the cost. You need that share pool. So we'll go to the working down below. First you take the number, then you take cost. This. So you take 6638 and 9345. So they have given you the three cost. Now 5106. This is 5106 and this one would be 7188. No. That was the indexation cost. From indexation cost, deduct the cost. This is indexation allowance. So 7188 index cost minus cost. It is 2082. And your gain is 22812. Chargeable gain. So now, what do? You just add the total gain. 22812 plus. This is from the share pool. This is from the previous 9 day. 15500. Which is giving you 38312. So this is your total chargeable gain. You see? Substantial shareholding exemption is the next topic. This is new for ATX. So because this is new for ATX, was not there in tax, has a very chance of appearing in your ATX exam. And this is one of the area which is very frequently tested in corporation tax. So when you're disposing company shares out of a substantial shareholding, gain is exempt. That's why it is known as substantial shareholding exemption. So the gain that you are getting out of that disposal of share, if it is from a substantial shareholding, the gain is exempt. Losses are not allowable. A substantial shareholding is defined as a holding equal to or greater than 10%, and you should own the shares for at least 12 months out of the 6 years before disposal. The company disposed must be a trading company or the holding company of a trading company during the 12-month period. Now, the company disposed does not have to be a trading company immediately after the disposal. Okay, so the effect of the rule is this. This will enable you what? Part disposal. That means partly you can dispose out of your substantial shareholding so that you can continue for this relief for 5 more years after the vendor's holding falls below 10%. In deciding whether substantial shareholding is held or not, you have to see percentage. Okay. For group, it should be greater than 50%. Okay. Shareholdings held by other group members has to be greater than 50%. This has to be taken into account. And when there is a share for share exchange, then the holding period of the original share is amalgamated with the holding period of the replacement share in determining the 12-month period. That means when you're holding a share and when you are replacing it with another share, the holding period's share and the replacement share together, they are added and it is taken into account to determine whether you have met the 12-month rule or not. Now, what about the shares owned for less than 12 months? Shares owned for less than 12 months can still satisfy the ownership condition. How? But there is an if condition. Remember all these conditions you should know. Okay. If shares being disposed of are in a new company and new company receiving assets from another 75% group company and assets transferred are held and used in the trade of another group company for 12 months before the transfer. This is important when you're considering corporate reconstructions and reorganizations. So all these conditions you should know. Now, let us summarize the differences between individuals and companies. So the gain for individual, it is subject to CGT. For companies, it is corporation tax. And it is taxed separately from income. Companies corporation, it is included in TDP and it is taxed along with income. Annual exempt amount is not available for companies, but it's available for individuals. Indexation allowance not there for individual, but it's there for companies. Matching rules for shares. First rule, same day purchased. Second, following 30 days. Third, from the share pool. For companies, first rule is same, but the second rule is different. It's in the previous 9 days. And the third one is again same. But remember, when you're taking the share pool, you have to take the index cost. And this is a very useful for your revision practice, this tables. Next, gain and loss. Whatever your size of holding, it is chargeable if it's a gain, and if it's a loss, it's allowable. But for companies, as we can see, there's a substantial shareholding, your whole gain might be exempt. Treatment of capital losses. You can offset against current year gains without restriction. You can carry forward against future net chargeable gains after deduction of AEA. Same, you can offset against current year gain without restriction. Next, you can carry forward against future net gains, but this is subject to some restriction. Then, business asset disposal relief, BADR, gift holdover relief, PRR, that is private residence relief, and IR, investor relief, are there for individual, not there for companies. Rolled over relief is there for individuals and is there for companies as well, but good, not on goodwill. Now let us summarize TTP. So trading income. These are the differences under the trading income for the companies with the individuals. For companies, no private use, but for individual, there were private use. Interest payable and receivable for non-trade purpose is equal to interest income. Enhanced R&D deductions is allowed, that is 130%. AIA. This must be split between related companies. This was not there for individual, and only one AIA for group companies. Coming to interest income, the next income. All interest receivable, deduct interest payable for non-trading purpose, and if deficit losses, relief is available. Next, QCD. This is paid gross. You have to deduct it from your total profit. Overseas income.
Again, include gross, double taxation relief is available and dividends are excluded from overseas income. Property income, difference for companies. For property, this is accounting period basis of assessment. And interest on buying the property you have to deduct from interest income. And the loss relief available against other profit. Chargeable gain, there is an indexation allowance which will reduce your gain. You can offset capital losses. No annual exempt amount. Rolled over relief is there. And this is the old relief for companies. Share matching rules. Same day, previous 9 days, share pool. Then, substantial shareholding, the new topic in ATX. Disposal out of greater or equal to 10% holding, gain is exempt. And you have to own for 12 months out of previous 6 years. It has to be a trading company. Gain is exempt, loss is not allowable. Now let us do questions. Test your understanding 3. So in test your understanding 3, here for each disposal explain whether SEC applies. First one, Omega bought 15%, which qualifies for SEC. Shares were acquired on 1st Jan 2016. On 30th June 19, disposed 10% holding. Remaining 5% holding was disposed on 31st December 2023. So now, both the disposal will qualify for SEC. The first 10% and the next 5%. Why? Because the first disposal of 10%, there has been held for 12 months. If you see the date, this is 1st of Jan 2016, this is 30th June 2019. At least 12 months time is done. It's hold. Next will also qualify. How? Because he has 15, disposing 10%, that means remaining 5%, which is now less than 10%. But still it will qualify for SEC. Okay. Second disposal qualifies because it was made out of only a 5% holding. Because Omega held at least 10% holding. See, first it was 15, then he disposed a 10% holding. Because Omega held at least 10% holding throughout a 12-month period during the 6 years before the second disposal. So before that second disposal, he held 10%. 10% holding was there. He disposed this 10% holding. But till then, for the 12 months out of the 6, he was holding the 10%. That's why before the second disposal, that's why this will qualify for SSE. Now moving on to illustration 3. Here you can see there are so many notes. Note 6 are there. You have list of expenditure and income. Okay, and some notes to it. What you are required to do: A, compute tax adjusted trading profit, stating clearly your treatment of any interest paid or received. B, compute the corporation tax liability for the year ended 30th September. Now, so he's a UK resident manufacturing company with one associated company. Statement of profit and loss for year ended 30th shows a net profit before taxation of 331,700 after deducting following expenses and including following income. That means your starting point is this. From here you have to do the adjustments, add, deduct. Okay, so accordingly we'll read the notes and do. So now first let us start. Since this is just computation, you can straight away do one after the other. So let us quickly do that. So for A, it is profit before tax will start. 3,31700. Then we'll add what? We'll start with the expenses first. So we'll start adding the expenses. You have to read the notes. You just can't keep adding the expenses as it is. Okay. So loan note interest. We'll read note 1. Okay. This represents interest. So note 1, this represents interest on loan notes issued by this one to build a factory extension. The figure of 12,000 includes accrued interest of 3,000. Okay. Then so anything relating to loan? No. So one is loan note interest, other one is long-term loan interest. Note 2. This represents interest paid on a 10-year loan raised by Black to purchase property which is currently led to another company. This is to purchase a company. Remember, you should only add back those interest, those expenditure, which should not be deducted from net profit, which are non-trading. If it's trading, like the first one, this is why you have taken the loan for the factory extension and you are in a manufacturing company. This is trading activity. So this was deducted. You don't have to do any adjustments with it. Leave it. But the second one, long-term loan, note 2, this was to let the property to another company. This is investment. This is non-trading. It should not be deducted, but it was deducted before. That's how you got this net profit. Now add back. Add back that 6,000. So loan, long-term loan, 6,000. Next, depreciation. Yes, depreciation is a non-cash. Anyway, it has to be added. 11,000. Next, QCD payments. QCD payments will be deducted from the total profit, not here. So add back QCD 5,000. 3,700. Now time to deduct the income. Loan interest, note 3. The loan interest receivable is in respect of a loan made by Plug to a supplier. So the third one, you have to do an adjustment. The loan interest receivable. Remember, for income, there is no income from non-trading. You will not have any. From trading, I'm sorry. Anything to do with loan, you will not have any income from trading. So this has to be what? Loan interest receivable of 8,000 has to be deducted. It was added, now it's deducted. Next, rents, note 4. The rents receivable relates to the property let by this one. So that is non-trading. You can't take it. 7,000. Deduct. Next, insurance recovery, note 5. This represents amount recovered from the company's insurers in respect of goods destroyed in the fire last year. The cost of this goods was written up and allowed as an expense last year. So tell me, insurance you will deduct or not? No, you will not, because it was allowed as an expense. So insurance, leave it. Profit on disposal of old headquarter building. Note 6. On 14 July, company sold an old building for this much, had been purchased in this for this much. At the time of its disposal, building was held as finance team at the value of this much due to the revaluation in 2019. Profit on disposal of old headquarter building is non-trading. 100. You have to add back, deduct, sorry. Profit and sale of building. Next, dividend received from non-group company. Dividend is anyway not allowed, so 10,000 deduct. One more thing you have to deduct. What is it? Which is not here. Capital allowance, note 7. That's why you have to read all the notes. And the eighth one is the indexation factor. So it is 34,700. This you have to deduct. So this is your new adjusted trading profits. Now coming to be corporation tax, you have to find out. Right? Remember, for corporation tax, you need your tax adjusted trading profit. You need this here. So 194,000. Next, this is trading profit, tax adjusted trading profit. Okay. Now you need interest income. You need property income. Then there is a chargeable gain. You don't have anything with overseas. Okay. So how much is the interest income? It is this one we are talking about. The second point. Interest income when you are letting to another company. So it's 6,000. Okay. And what is the interest income? Remember your expenses, that is the interest. Interest income is 8,000 here. So you have to deduct your interest expense from interest income. That's how you get your interest income, 8,000 from 6,000. So it's 8,000 minus 6,000. That's how you are getting your interest income of 2,000. Now, property income. So all the other non-trading activities, property income, how much? Rents received related to property. The fourth, note 4, 7,000. Okay. What's next? Chargeable gain. For chargeable gain, there's a working that is required because you have to do indexation factor and all those things. So I'll write working 1. Okay. And deduct your QCD of 5,000. And you will get your TTP. You need your TTP because on this only corporation tax will be there. Okay. So first we'll do the working 1. Proceed. Less cost. It is in note 6. Okay, so the proceed is 494,800, cost is 150, and you have been given the indexation factor here 0.856. $494,800 deduct 150,000. Do not straight away start taking indexed. Okay, first it has to be unindexed gain always. This is known as unindexed gain. Deduct your indexation allowance 0.856 into for the cost 150,000. 128,400. 216,400. This is your chargeable gain. So that's what I'm going to write here. 216,400. Now what? I need another working for the rate of corporation tax. You need your TTP for it. So now I can get my TTP straight away. First let me get my TTP. It's 414,400. Okay. Always check whether there are 2 financial year or there is 1 accounting period. You have to check that. Okay. For that you need this. So this is year ended 30th September 2023. So it has 2022 also, 2023 also in it. And the rates are different. Okay. And you need what? You need augmented profit to decide the rate. And you need your dividend receipt for it, which you have to add with TTP. Do not forget all this. So we'll do the working too. TTP 414,400. Add your dividend 10,000. Augmented profit AP is 424,400. Now remember, your upper limit and lower limit also will change. Upper limit is 50,000. Lower limit is 250. Okay. First we'll take the months. Okay, so it's September. So the year end is 30th September. And when does your starts? From 1st April. So April, May, June, July, August, September, 6 months. That means first 6 months is in FY 2022 and the remaining 6 months. So half. You have to take half of this. Upper and the lower limit. $25,000 and $125,000. This amount is more than this, more than the upper and the lower. So main rate will apply because it is more than the upper main rate. What is the main rate? %25. Okay, and when did you receive the dividend? Okay, they have not mentioned anything about the dividend. Okay, now let us go to the corporation tax, TTP. Okay, then corporation tax, FY 2022, FY 2023. 414, 400, 414, 400. For 2022, it is 19% that will apply. And for 23, it is the main rate for 6 months. This is also for 6 months. Now, $39,368, 51,800, add together 91,168. This is the corporation tax. You can't take one corporation tax figure because there are 2 years, 2 accounting periods. They're straddling by in 31st March. So now, that's it. Now let us go to test understanding 4. This is a long question. Let us quickly read the requirements. Calculate corporation tax for a 9-month period ending 31st December. State the date by which the corporation tax return for the period ended 31st December should be submitted. Explain how the company can correct the return if it is subsequently found to contain an error or mistake. You will expect this type of question as well, not just this calculation part. You have to be prepared for both. So you have dividends received, profit on disposal of shares, loan interest received, different types of income you see, leasehold property. Company will not make any short life asset election. Tax written down value of all the pools 1 nil. Okay, this is for capital allowances. They have given you this table. Calculate capital allowance. This is how they normally give it. They don't give you the capital allowance. You have to calculate, and the trading profit. Okay, so they are preparing accounts for 9 months. Remember to time a portion. Trading profit is 345,206. Before taking capital allowance and any deduction, this figure is given. Okay, so now let us start with test your understanding 4. Okay, so what should be our first working? From trading profit, you have to deduct capital allowance. You have to deduct lease premium. So first we'll calculate this, second we'll calculate this, and we'll see any other income we have to do or not. Okay, and then what's next? If you can scroll down, you can see. Okay, you might have some property income as well. And some loan interest I can see. So you might have property income, loan income, working for this and this, and chargeable gain. They will always give you something with chargeable gain along with the trading profit and other incomes. And then TTP and corporation tax. Okay, chargeable gain would be for this, profit on disposal of shares, for this one. So now let us quickly start with the calculation of what? Capital allowance, working 1. Okay, So for this you need a table. So we'll start with capital allowances. First column, AIA or FYA. Main pool, special rate pool, and allowances. Now, so the ones not qualifying for AIA or FYA are the cars 1 to 50, cars over 50. So we'll see in the plant and machinery. We can see we have a machinery, leave it because it is eligible for AIA. So we have a lorry, leave the lorry aside, let us go to the car. So emission 1 to 50 is this one, 11,200. It will go to the main pool. Then this is 75 over 50. This will go to the special rate pool. And this 13,000 zero emission will qualify for FYA. Computer will qualify, okay, for the allowance. Lorry will qualify, building, machinery, all this will qualify. Okay. Now, so let us quickly go and put it in the correct table. 1 to 50, the 45 will go to the main pool, 11,200. Then over 50, the 75 will go to the special, 14,600. Next, qualifying for AIA, plant and machinery. Okay. So for plant and machinery, if there is a working under working, make a note next to it. Note 1. That's the first one, that's why. Okay. So now, plants qualifying for this one. So we'll write the note 1 here. Qualifying for AIA. Okay, we'll add all. This one will qualify. Okay. Then this one will qualify, the building alteration essay for installation of machinery. Then the lorry will qualify. What's next? The computer will qualify. So the 4 things will qualify for AIA. Will add up 79, 380 plus 3,700 plus 42,000 plus. So the total is 129,480. Only this much AIA you will claim. Okay, 129,480. 129,480. This much of AIA you will claim, and this will immediately you will write it in the allowance column also, because later if you write you might forget. All this working you will do in Excel. Next, so in the main pool it will be 0 after you deduct this. Now 11,200 and 14,600. What's the next? WDA. Remember, this is for 9 months, short period of account, so you will scale down. 18% into 11,200 in the main pool in for 9 months. It's 1512. Immediately you will write this in the allowance, 1512. Next, for 14,600, that's a special rate pool item. WDI will be 6% into 14,600, again 9 months. 657. Allowance 657. Next, the zero emission car. Zero emission car. This is 13,000. It will qualify for FYA. 100% FYA. So this 13,000 is an allowance. So here in the main pool it will be 0. Now the total 9688 13943 and the total allowance is 144649. This is the total allowance. Total allowances. This you will write here. From trading profit you will deduct. Later on we'll keep it. Next, working. We'll do all the working today. Working 2. This is deduction for lease premium. Okay. So the leasehold building has been used for the business. So lease premium you have to calculate. Okay, we'll see what is the amount of the lease. So premium is 75,000. It's a 15-year lease. And so this is on 1st of April 2023. They have acquired a leasehold office building, premium 75. They used it for the business purpose throughout the period ended 31st December 2023. Then they decided to let out an old warehouse. On 30th September 2023, they received a premium of 50 for the grant of 5-year lease and an annual rent of 14,800 which was payable in advance. Okay. So now, first let us do for the 75,000 lease. So this is the working. So when I taught you lease during income tax, okay, so you get the premium into, this was the formula, do not forget that, 15 years divided by 50 equal to 54,000. This is the lease premium. Now, so this is deductible over the life of the lease, okay, for the 9-month period. Okay, so you take this 54,000, this is annual, so for 15 years, 3,600 for 1 year, you have to take for 9 months, 2,700. So this is the lease premium, 2,700. These boxes are very important, this one, then this one, because you have to deduct this from your trading profit. Next, working 3. Property income. Okay. So this you get a premium. You see here. They have let out an old warehouse, so from which they are getting a premium. This is they are getting a premium. They are not paying it. So they received a premium of 50,000. Annual rent is 14,800. 5-year lease. Okay. So now, this is on 30th September. Okay. They have asked you for 31st December. Okay. So on 30th September. Now when we are getting to the property income, remember there are two. One is the premium, one is the rental received. So the premium is 50,000 into 51. This is for 5 years, divide by 50. 46,000. And the rent received, they have given 14,800, but you have to take only for 3 months because it's from September to December. And 14,800 is annual. They have given you. Okay, they have mentioned it also there. If you see under property, you see annual rent which was payable in advance. So you have to only find for 3 months. It started on September. So add both. 49. You see, this is the rule of what? These rules are from where you are taking when we studied the individual, sole trader, income tax. Remember, from there we are carrying it forward to company tax. This is why you need the knowledge of all the areas very well. So this is your property income. The total of rent and premium received is what? Nothing but your property income. Next, working for chargeable gain from disposal of shares. We'll see whether substantial shareholding exemption is there or not. For that we need to read the information. So leasehold. For dividend receipt and loan interest, not much working is required. You can just do plus minus and get the answer. But chargeable gain needs working because we need index gain, unindexed, and we have to say exemption is there or not. So on this date, they sold 10,000 shares for this much. Share pool containing 20,000. Total cost is this much. Index cost in the share pool is this much. Their shareholding never represented more than 1% interest. That's why substantial shareholding exemption, SSE, will not apply. That means this is chargeable, it's not exempt. They never had more than 1% interest. So now, what should you do? Tell me. Yes, exactly. Find the gain. Disposal proceed is given, but cost you have to find out. Okay. Now, so disposal proceed 37,574 less cost. See, for cost there is a working. Okay. You need the share pool. Share pool. You need the number. Always whenever share pool is there, drop the number column, cost column and index cost. I see. Okay. Brought forward balance. They told there were 20,000. They have given the cost 23,250 and 23,490. This cost was given in the question. How much they disposed? 10,000. Because you don't have anything on the same day and previous 9 days. So you have to take from the share pool. This you will get. This is the missing. You have 1, 2, 3. So this is the missing number finding out. How do you get it? It is simply 10,000 divided by 20,000 into 23,250. So 11,625. Same way this also. Index cost 10. Just change this to 23,490. 11,745. Okay. So this and this you need. Okay. So now the cost is 11,625, 25,949. Indexation allowance. Remember, it is the indexed cost minus the unindexed. 11,625. Indexation allowance is just 120. 25, 829. This is the chargeable gain. This is also in box because I need it later. So what else? What else do I need? The rate of corporation tax, but that comes at the end. We have to find TTP first. So first let us do till TTP. Now we have all the figures that I need. So straight away from trading profit. Trading profit is given 345,206. Deduct capital allowance 144,649. I've already put the number in the box. Lease premium. How much lease premium did you pay? 2,700. 197,857. Tax adjusted. You have to name it. This is tax adjusted trading profit. You have to keep your property income, interest income, and chargeable gains separate from trading income. Trading profit, I'm sorry. Chargeable gain, interest income, property income separate from tax adjusted trading profit. Okay. Then property income. This is working 1. This is working 2. Property income. Working 3. 49,700. Then we have interest income. Remember, dividend will not come here. Dividend is for this one. Augmented profit you need. So loan interest part I have to read. Loan interest is 6,000. 3,000 was accrued. Loan was made for non-trading purpose. So add 6,000 and 3,000. And then chargeable gain. Working 4. 25,829. Add up 282, 386. This is your TTP. On this you have to calculate your corporation tax, but you need the rate. To decide the rate, you need a working. Corporation tax liability working number 5. So we'll go to working number 5. Get your TTP 282, 386 and add your dividend. How much was the dividend? Dividend is 20,000 and it's from unconnected company. Now upper limit is 50, lower limit is 250, but as you can see this is more than that. It will be 25% rate. You don't even have to find the 9 months of this. Anyway, it will be lesser than this, and this amount is more than the upper limit, so the rate is 25%, the main rate. And if you see the AP, we'll see in which year it falls. Is very important. This they have prepared 9 month 31st December. So when did it start? From 1st April. 1st April 2023 to 31st December 2023. So it does not straddle with 31st March. It's after that, and everything is in 2023. So one main rate 25%. 25% is the corporation rate. So now just apply 25% with this rate. 25% with TTP 282, 386, 7597. This is your corporation tax. Now let us go to part B, where we have to write self-assessment corporation tax return. So now tell me when they have to make. they have to do it by 12 months from the 31st, from the end of the accounting period. So by 31st December 2025 they have to submit online. Okay, submit online. This is by self assessment. When can they amend? Remember the due date, part B. They can amend anytime before this date. Okay, that means 12 months after the filing date. If there is an error, then what happens? They can claim for relief before 31st December 2027. Being 4 years from the end of the accounting period. When is the accounting period? 2023. 31st December 2023, right? 4 years from this is 2027. 31st December 2027. So if they make an error, they can make a claim for this relief before this date, 31st December 2027. Next, research and development expenditure. This is new for ATX, so it has a very high probability of occurring in your ATX. In order to encourage more spending on R&D, additional tax reliefs are given for qualifying revenue expenditure incurred by companies. There are separate schemes for SMEs and large companies, but only SME scheme will be tested in your ATX. You do not need to know the definition of an SME for R&D purpose. Schemes for SME. Enhanced relief is available if company spends money on qualifying R&D and it is defined as defined by the GAP, and guidelines are given from the Department for Business, Energy and Industrial Strategy. SMEs can deduct an additional 86% of qualifying expenditure for tax purpose. 86, you have to remember this percentage. If the deduction creates a loss, it may be surrendered in return for a cash payment from HMRC, 10% of the surrendered amount. Remember, if the deduction creates a loss, you can surrender this in return for a cash payment from HMRC, which is equal to 10% of the surrendered amount. Now, the surrendered amount is the lower of unrelieved trading loss after a deemed current year claim and any actual carryback and group relief claims, 186%. Because they told additional 86, so you add with 100. So 186% of qualifying R&D expenditure and unrelieved trading losses. Whichever is lower will be the surrendered amount. If surrendered in return for cash, loss cannot be carried forward for future relief. This you have to remember. Next. So qualifying R&D expenditure must be revenue expenditure that is relevant for the company's trade. Okay. It can include the expenditure on the following. Remember this expenditure. Staffing cost. For example, you need staff directly that are involved in R&D work. Okay. Including NIC, class 1 employer, and pension contributions, but excluding taxable benefit. So when you are taking the staffing cost, you are taking the class 1 employee NIC and pension contribution, but you are not taking taxable benefit. That is class 1A NIC. I hope you can recall NIC. I've covered it in income tax. Agency staff for R&D. These are qualifying expenditure. Material, water, fuel and power for R&D. Software directly used in R&D. Payments to subcontractors. Now, it does not include contributions to other bodies for independent research. You are giving money to some other party, third party, to do independent research. You cannot claim relief for it. Next, rent. It is not a qualifying expenditure. Expenditure covered by a grant or a subsidy. Again, it is not a qualifying expenditure. Payment to subcontractors. When there is a payment that is made to an unconnected subcontractors, unconnected, only you will get 65%, that is half of 130. Only 65% of expenditure will qualify for enhanced tax relief. If R&D is subcontracted to a connected company, then R&D tax relief can be claimed on the lower offs. Then it is lower. It's not 186, but it's lower if it is subcontracted to a connected company. Payment made to subcontractor and relevant expenditure to subcontractor, whichever is lower. Two companies will be classed as connected subcontractors if either both companies are controlled by same person or both one company controls the other. Now, it is possible for company and subcontractor to jointly elect to be treated as connected even if they are not. Why? Because if you make this election, this will apply to all the payments made under the same contract. Then this election will apply to all your contract, all the payments that you make under the same contract. So the claim must be made in writing and made within 2 years at the end of the engaging company's accounting period in which the contract is made. Now, what about capital expenditure? Capital expenditure qualifies for 100% R&D capital allowance, but it excludes land. Okay, all the capital expenditure qualifies for capital allowance when we are purchasing it, so it is fully deductible as a trading expense. However, it does not however qualify for any additional R&D relief. When the capital assets are sold, the proceeds will be treated as a balancing charge and therefore it will be taxed as trading income. Now let us do a question. Test your understanding 5. So you have to advise the company of any tax relief available in respect of the expenditure. So we have been given some expenditure. Remember, all might not be available for tax relief. Market research, staff directly involved in researching project, administrative support for R&D department, hidden light in R&D department, new software and agency for temporary R&D staff. So tell me, what is allowable and what is not allowable? Market research, no. And what's next? Admin support. These are allowable expense, but they are not qualifying for additional relief. So 8,000 and 5,000, total 13,000 will not qualify for additional relief. And the expenses that will qualify is this 20,000, the 9,000, the 4,000 and the 10,000. So if you add all the four, it adds up to 43,000. This will qualify. Okay, so if it qualifies, what percentage you have to take? %186%. You have to take 186% of 43,000. $7,980. So this you add with this 13,000, 92,980. This becomes allowable amount. Okay, you can deduct this 92,980 against your taxable profit. Okay, so this is the total allowable amount. Now, one thing I will make a note here. This is not here. If you see, this is the total allowable amount, right? 92,980. But the actual expenses will be 43 plus 13,000 because the 186% is the claimed amount. Okay, so 43,000 plus will be 56,000. This is the actual expense, right? This has been charged in the P&L. This goes where? In the P&L as an expense. Therefore, an additional is deducted in adjustments to profit computation. That is, if you take 92,980 minus 56,000, what is the total? 36,980. This is deducted in adjustments to profit computation. So this you will deduct from the profit. This is only for the profit computation. They didn't ask this part. Okay, this part they didn't ask. This is just a note. The only thing is you should know the relief. Okay, the additional amount if you have to deduct, you have to deduct that as well. Now, test understanding 6. So this is about also tax relief. So this is a small size company. Purpose for R&D pays corporation tax at a small profit rate and spends 8,500. So tell me. So the normal R&D expenditure allowable deduction already charged in the accounts of 8,000 will give a tax saving. How much? Because this you will deduct as an expense, right? So you can save tax here. This is small profit rate. So 19% corporation tax you will pay on 8,500, which is 1615. This much you can save tax. So what would be the extra deduction? They can claim an extra deduction of 86% on this 8,500. Okay, that means it will give you an additional tax saving. The more you deduct as a tax, the more you can save tax, right? This is about tax relief. So take 86% on 8,500, 73,110. Okay, on this you are saving 19% of tax. Otherwise you would have paid 19% tax, but this much you are saving in corporation tax. So this you add with this. First 100% on 8,500, that's why we paid 19. The next on 86% of this 8,500, and then you are taking 19%. Oh, straight away you can do like this. Take 186% into 8,500. Get the amount. It's 15,818. Take 19% of it. 3,004. This is how much tax you will save. Okay. So rather than doing it like this, what they have done, they have taken 19% of 8,500. This is 100%. And 86% of this, and on that they have taken 19 and added the two figure. That way also you can go straight away, just take 186 on 8,500, apply 19% small rate corporation tax and get the amount, one figure. So the total tax saving is 3,004. Now, intangible asset is the new section, and this is also new in ATX. So intangible assets, as we know, is an asset which you cannot touch. Okay, so these are the following items that are there in intangible assets. Purchased goodwill, not goodwill on consolidation. Patents, copyrights, trademarks, brands, intellectual property and know-how. Now, what is the tax treatment of intangibles other than goodwill? Goodwill we are keeping it separate, okay? So the tax treatment of intangibles other than goodwill follows the accounting treatment. Now, expenditure relating to related to intangibles which has been charged in the company's statement of profit and loss will be allowable for tax purpose. Now, so the tax treatment. It is written off as incurred. Examples: royalties, abortive expenditure, cost of creating internally generated intangibles. Now, this are capitalized. Okay, amortization of, so writing down capitalized assets, amortization of intangible assets, impairment losses, and all are allowable cost. No adjustments to net profits required. Okay, now you can make an election. Instead of allowing the amounts charged in the accounts, you can make an election to write off the cost of the capitalized intangible asset against the profit for the tax purpose. For the tax purpose, you are saying the capitalized intangible asset you are deducting against the profit at a rate of 4%. That means 4% of the cost of capitalized intangible asset you are deducting against the profit. And any accounting debits for amortization or impairment loss would then be disallowed. Remember, if you are making this election for you to deduct 4% of the intangible assets cost against the profit, you can't charge amortization or impairment loss, then it will be disallowed. So this is useful where asset is amortized at the rate of less than 4%. Then it's good to make this election, because then you can deduct maximum of 4%. But if your amortization is more than 4%, this is not useful. Better to deduct more than 4%. So the asset is not if the asset is not amortized in the accounts, better to make this election. So the allowable amount is calculated pro rata for accounting period less than 12 months. If it's 9 months, then it will be 9 months. Now, so the election is irrevocable, you can't change it, and it must be made within 2 years at the end of the accounting period in which the asset was acquired or created. Before moving on to disposal, let us do questions. Test your understanding 7. What relief is available to Rome PLC for its intangible assets? So you have one patent, one brand name. Brand name is capitalized but not amortized. Patent is capitalized and it will be written off on a straight line over a 10 years on a month by month basis. Reference date is 31st March each year. So on 1st December 2023, they purchased the trade and assets of another company in the same business. They paid 2 million, included 35,000 for patent with a 10-year remaining useful life and 200,000 for brand name. So first we'll go with patent, then we'll explain the brand. So I have the answers with me. First let us finish with patent. Patent, if you see, it's 10 year, so they have been amortized at 10%. Number 1 point. Number 2, the accounting treatment you have to talk about. It is tax allowable amount. Yes, you can deduct this amortization. Next, how much? What is the amount for patent? 35 divided by 10 is 3,500 per annum you have to pay. So this will be amortization and it's a tax allowable amount. No adjustment to profit is required, as we saw in the table, in the diagram before. Next point, what is the allowable amount? For that, this is 1st December. So you have to take from 1st December to 31st March 2024. It's 4 months. So you have to take the amortization for 4 months only, not 3,500. So it will be 1167. This is the amount, because it is calculated on monthly basis and it was acquired on this date. Now, will you advise the election to be made? No. Why? Because it's a 4% election, whereas your amortization is 10%. It's more. So it's not advisable for you to make the election, because if you make the election, your tax allowable amount would be less than the amortization available, which is not good. Coming to the second brand. Brand, if you see, it's not being amortized, so it's beneficial for you to elect, because at least you can deduct 4%. So take 4% of 200, it will be 8,000. This you can deduct, and this should be deducted in the adjustment of profit. Okay. Now, so the full annual allowance is available in the year ended on this date, as the accounting period is 12 months in length. It is irrelevant when in the accounting period the brand name was purchased. Doesn't matter. You will get the full annual allowance. Next, for intangible assets, when we dispose it. So, the proceed of sale will be compared with the tax written down value to give you a profit or a loss. Any profit on disposal, any profit or loss made on disposal of an intangible asset in the account will give rise to an identical tax profit or loss. Okay. Unless the tax written down value at the time of disposal differs from the account's value. This occurs when the election of 4% has been made, because usually when election is not made, your profit and loss on the disposal of intangible asset will be equal to your tax profit or loss. Why? Because expenses for intangible assets are allowable for tax purpose also. What you have deducted in accounts to calculate the profit and loss is allowable for tax purpose also, to calculate tax profit or loss. But when you are making the 4% election, it differs. Your profit and loss differs to your tax profit or loss. Now let us do a question on disposal. Test your understanding 8. State the effect for tax purpose on the disposal of intangible assets. Assume Rome in the previous illustration decides to sell the business that it bought on 1st December for 38 for patent and 250 for brand name. The sale is made on 1st April 2026. So now I have the answers with me. First, let us start with the patent. Original cost was 35,000. Okay, it was there in the previous question. And the brand name's original cost was 200,000. Now amounts will be written off. Remember, the first one was for only 4 months from December to March, and then it will be annually the amortization 10% till 2026. That's why. So 2024 year ended 25 and 26. This will be written off and your proceed. So when you compare this two, this is the profit. Already it is included in your taxable trading profit. Okay. Proceed minus your proceed is more than your tax written down value. It's a profit. Coming to the brand name, you have made the 4% election. Okay. So here you have calculated also 4% of 200 is 8,000. This amortization amount. So this you will deduct for all the 3 years. Compare with the proceed. This is the profit. Okay. Any accounting profit is deducted for tax purpose in the adjustment of profit computation is replaced with the following taxable profit. So here, because 4% election is made, company cannot follow the accounts in relation to the profit arising on the brand name. Tax treatment of goodwill. So first we have finished the other intangibles. Now we are moving on to goodwill. Goodwill purchased is treated differently from other intangible assets. Amortization or impairment losses relating to goodwill are not allowable for tax purpose. That means you can't deduct it as an expense for tax purpose. If you have deducted, you have to add it back with the profit. So when you're disposing goodwill, you compare the sale proceed with the cost to give the profit or a loss. Any profit is a trading profit, any loss is a non-trading debit, and it can be set off against total profit of the current period, group relief if part of 75% group, carried forward and offset against total profit of future period. There is no option to carry back non-trading debits arising on the sale of goodwill. Special intangible rolled over relief. If a profit is made on disposal of any intangible asset and you are acquiring a new intangible asset within 12 months before or up to 36 months after the disposal, then you can defer the taxable profit. Part of it could be deferred, just like rolled over relief. The maximum deferable is lower of disposal proceed or amount reinvested, less cost of the original intangible asset. Special intangible rollover relief is available for goodwill as well as other types of intangible assets. So this intangible rollover relief is available for both goodwill and other intangible asset also. Now let us do a question. Test your understanding 9. So you have to calculate the taxable profit if intangible rollover relief is claimed and the new intangible cost is 35 and in B 25,000. So here they sold an asset for 30, original cost was 20, tax written down value was 12 and purchased another intangible asset 3 months later. So now sale proceed is 30,000. This is A I'm doing with 35,000 and tax written down value. Remember you have to compare with tax written down value. Okay, which is 18,000. Now this is the trading profit. So the rolled over relief will be rolled over relief that you have to deduct will be lower of proceed and amounts reinvested. So what is the proceed? Proceed is 30,000. What is the amount reinvested? The cost of the new 35,000. See, 35,000. So the lower of the two is the proceed, 30,000. And you have to take this from the cost. So cost, this cost, 20,000. So the lower amount is 30,000 minus the cost, which is 20,000, 10,000. So 10,000 is the amount deferred. So 10,000 is the amount that will be deferred. So 18 minus 10, 8,000 is what? Taxable trading profit. Taxable trading profit. Okay. If you see, the 8,000 that cannot be deferred is equal to the amount of the amortization that was claimed on the original cost. You see, the cost was 20, isn't it? And tax written down value was 12. So 20 minus 12, 8,000. Right? So this was the amortization that was claimed on the original asset, which is 8,000. So this you cannot defer. It is the same as your taxable trading profit. Now coming to part B, 25,000. Okay. So in 25,000, you compare with the sale proceed 30, 12, 18. This is same. The only thing is this rolled over relief will change. It would be the lower of the proceed. Proceed is 35. Amount reinvested is 25,000. Lower amount is 25,000. And if you see, cost is 20. Amount reinvested is 25. Cost is 20,000 this time. So the amount deferred is what? 5,000. So 5,000 is a rolled over relief this time. Just change the 10 to 5 and this becomes 13,000. Okay. This also is the this 13,000 is also equal to the amount of the amortization that was claimed on the original asset. How? See, 20 minus 12. Tax written down value and cost was 28,000, right? So with this add, you add the proceed that was not reinvested. You did not invest 5,000. So you add 5. 13,000. You see? This is just a note. Now the expenditure that reduces the tax. Some type of expenditure differs the tax and some reduces tax. The examples which differs the tax are like when you invest in qualifying capital assets like rollover relief, you defer the gain on the sale of qualifying asset. And second way you can defer the tax is when you invest in intangible asset. Rolled over relief for intangibles, you defer the profit made on the sale of intangibles. Now this cost of intangibles. So this can both defer the tax and reduce the tax. How? When you invest, the cost of intangible except goodwill can be written off at 4% or in line with accounting treatment. So how do you reduce tax when you invest in R&D? 186% you can reduce. R&D tax relief. So for SMEs, deduct 180% of qualifying expenditure from taxable profit or repayable tax credit. Now let us do a question. Illustration 4. So illustration 4 is on the expenditure that reduces taxes. You have two transactions and you have to calculate the tax savings. And also explain the corporation tax consequences. First transaction, okay, so this is a profitable trading company. Prepares its accounts to 31st March each year, not a part of a group. Year ended 31st March 2023. Taxable total profit is 800 and it's budgeting 1.2 for 31st March 2024 before considering either of the transactions below. It is now September 2023 and company is considering the following. Purchase of the new headquarters building for 375, replace its old building which is sold for 410, giving us chargeable gain of 90, which is included in the profit of 800. Okay, next is about R&D. So estimate it will spend 100 on staff cost and 30 on consumables. So now we have the solutions for both. First we'll purchase the headquarter. So this is a rolled over relief. Okay, partly you have reinvested. And the second one is about R&D tax relief. So what is the gain? They have made a gain of 90. It is included. So now they can claim ROR, rolled over relief. So proceeds not reinvested. Okay. So you have purchased the new building for 375 and you have sold the old building for 410. So 35,000 you have not reinvested. This will be chargeable. Okay. What is the gain? 90. What is taxable? 35. So the balance rolled over relief 55. You go back. So now find the base cost. That 55 will be deducted from the cost of the new building. New building is 375,000. 320. Okay. Now they also told the consequences of the in the corporation tax. Okay. So now what happens? Some will be deferred, that means some will not be taxed, that means they can save some tax, right? So this claim will reduce the total profit. It will reduce the total profit by how much? 55,000. You see, rolled over relief 55. It will reduce the profit. That means they can save the company tax at 19%. We'll see why. because it's 31st March 2023. Okay, and they have sold it in March 2023. Because they have sold it in 31st March 2023, it falls in the FY 2022, and that time the rate is 19%. So 19% of 55 is this much tax they can save, and it is 9 months 1 day from this date, that is 1st of Jan 2024. Okay, and they can claim the ROR within 4 years from 31st March 2024, because this is the later of the accounting period in which the asset is sold or replaced. Now coming to RN day. So 186%. 186% you can claim on 130,000. Okay. So both the staff cost and consumable, they are revenue expenditure, so they are qualifying. So now just apply 186, so this one and to this. Okay, now R&D in the year ended 31st March 2024. This falls in 2023. So 2023 the rate is 25%. Okay, for this rate it is this rate. See, cost that they have incurred 100%, they must have already deducted against trading profit. Now additional 186, so they can extra 86% they can deduct. Okay, so this cost would already be deductible against trading profit, but Rose can now claim to deduct an extra 86% over 186 on top of the normal deduction. That is, normally 100% you can deduct, now 86% also, so 186% on the total. This 25%, so this is the corporation tax that you can save. You can expect questions like this, so be prepared for it. How much tax you can save, especially tax saving. This could be for any tax, income tax, IST, VAT, they will ask tax saving. The change, the impact you have to be able to show, not just the full tax computation. Okay. Next on the list, which is new and which is important, on which you might be tested in ATX, is transfer pricing. What is the aim of the legislation? This is necessary between connected companies. Companies are connected if one company directly or indirectly participates in the management, control or capital of the other company, or a third party directly or indirectly participates in the management, control or capital of both companies. Transfer pricing rules apply to both transactions with non-UK resident companies and UK transactions. This you have to get straight. Both non-UK resident and UK resident. HMRC wants to ensure companies cannot manipulate total UK corporation tax by substituting a transfer price that is below or above an arm's length price. Because normally what happens is, when you are connected in a group company, it happens parent might sell to subsidiary, subsidiary might sell to parent, or both the subsidiary of the same parent might sell to each other. They might lower the price below the market price, that is below the arm's length price, or raise the price. So one department or one branch is getting a good high amount of profit, the other one is at a loss. Okay, so they're manipulating. So one is saving tax, the one which is making a loss because of a difference in the, because of the transfer price, is paying a lower UK corporation tax. So what happens because of this? HMRC wants to ensure that you are not able to manipulate that. You pay the total UK corporation tax. That's why they have strict rules on transfer pricing, and you have to know these rules. So transfer pricing legislation covers not only sales but also letting, hiring of property and loan interest. When transfer policy is under review, the basic aim is to ensure that your transactions are recorded at an arm's length price. Arm's length means price which will be expected if parties were independent persons dealing with each other in a normal commercial manner, unaffected by the special relationship between them. Now you have to make an adjustment. Okay, so an adjustment may be necessary to increase the profit of the advanced advantaged company. So one gaining a tax advantage from the favorable price. If both parties are UK resident companies, what happens? The non-advantaged company may make an equal and an opposite adjustments to its TTP. A company must adjust its own profit under self-assessment and must pay any additional tax due. Otherwise, you have to pay penalty for it. Alternatively, company may enter into an advanced pricing arrangement with HMRC to agree that its transfer pricing policy is acceptable and avoid the need for subsequent adjustments. See, you will get one question on ethics, that's for sure, okay, in ATX. So this part might come as a part of an ethical question also with professional skill marks. So be very careful on this area. That's why I'm emphasizing on this area. Now, these are the companies covered by legislation. This is very, very important. This will help you to decide. Okay. Remember, not all companies will be affected by this legislation. It depends on the size of the company. If you are large or if you are a small or a medium. If you are a large company and you are selling to or you are buying from any company, remember, transfer pricing rules will apply because you are large. Simple way to remember is if you are large, whether you are selling to someone, you are buying from someone, transfer pricing rules will apply to you. Very simple. Next, if you are a small or a medium and you are selling to or buying from overseas company resident in non-qualifying territory, still transfer pricing rules will apply. But if you are selling to or buying from UK SME or overseas company resident in qualifying territory, transfer pricing rules will not apply. This table is your decision table. In your exam, this is what you can't obviously draw the table in your exam, but you need this to decide to whom you are selling, from whom you are buying, whether transfer rules apply or not. So in the exam, they will give you what type of company you are, large or small or medium, and to whom you are selling, to whom you are buying. But they will not tell you whether transfer rules apply or not. That you have to decide. So companies cover. So question will state companies large or medium or small. A medium-sized company will be treated in the same way as a large company if there is a manipulation. Remember, for example, where there's a deliberate attempt to divert the profit to a company paying at a lower tax. Often happens. Often what happens is big companies or medium companies, they divert their profit to a company where the tax rate is low. This is a lower tax. So if so, transfer pricing rules will then apply to that medium company on all the transactions with any company for that medium company. Now, what is a non-qualifying territory? Non-qualifying territory means one that is not in UK, one that has no double tax treaty agreement with UK, or if it does have an agreement does not have a non-discrimination clause. Under this situation, it is known as non-qualifying territory. And if a small or a medium company is buying or selling to this non-qualifying territory, transfer pricing rules will apply. So it is possible for the treasury to designate countries as non-qualifying. It is up to the treasury. They will designate a country as a non-qualifying or not. Okay. So you have to look for this factor, whether it's in UK or not, whether it has a double tax treaty agreement with UK or not, whether it has a clause that says non-discrimination clause is there or not. Then you can decide whether it's a non-qualifying territory or qualifying territory. Now let us do a question. Test your understanding 10. So this is about explain the effect of the transfer pricing legislation on each transaction. There are 6 transactions. First transaction, UK company is large, B limited, overseas company. So A sells 5,000 to B at 1.5 when the market value is 3 each. What are they doing? Transfer pricing rules will apply or not? It will apply because you are a large company. So you are buying or selling to anyone, transfer pricing rules will apply. TP. Second one, UK company selling to UK company, no transfer pricing. Third one, UK company large. The moment you are large, transfer pricing will apply. Here also large, transfer pricing will apply. Here you are medium, selling to medium, again no transfer pricing. Here you are large, transfer pricing will apply. So in this 2 scenario, the 2 and 5, no transfer pricing. Now we'll see. So the information as for 4 means this information are same. 1, 2, 3 are same. 4, 5, 6. So here A Limited makes a loan of 200 to B and charges interest at 2, but commercial rate was 8%. So now let us see. You see, so 1.5 into 5,000 is 7,500. Okay, the difference. Normally market value is 3, you have charged 1.5. So you have to, what should you do? Transfer pricing legislation applies in the first one, as I told you. A Limited must increase its taxable total profit by this much. The 1.5 adjustment is the difference between the market value and the price at which the units were sold. It is 3 minus 1.5, the difference. Because your price is 1.5, market price is 3. So you are having a lower profit. You are selling. Remember, who is selling is the one who is making a profit or a loss. A is selling. So A has to do the adjustment, not B. A earlier was having 5,000 into 1.5, which is 7,500. Okay. Earlier he is having 7,500 profit. He should have 5,000 into 3. Market price was 315,000. Already this was recorded. Now he has to increase further 7,500. The profit, taxable profit. You understanding? Taxable total profit has to be increased by the difference. Because you have to come to 3. 3 into 5,000, which is 15,000. Second one. In the second one, transfer pricing will not apply. So because transfer pricing will not apply, see, it does not apply. Unless the medium company profits are being manipulated. Third one, transfer pricing rules will apply. But you see, they are UK company large, but they are to the UK company. So A Limited again must increase its TTP by this much. And because B is a UK company, this time B also have to make an adjustment. Earlier it was overseas. So B Limited may make an equal and an opposite adjustment. Opposite. Because if it's a profit for A, it's a loss for B. So but it should be equal 7,500 only, but in the opposite direction. Opposite adjustments to its TTP, as it is a UK resident. Both A and B are UK resident. So we are considered about UK resident. You see? UK. If it was overseas, no one cares about overseas. What adjustment do they do there? We are not concerned about it. But if it's UK, both adjustments. Coming to the fourth one, TP applies. So it should have been 8%, but it's 2%. So the difference 6%. Interest you have to charge. That's what you have to do. So you have to increase your taxable total profit. Earlier you charged, see the difference. Earlier you charged at 2%. Now while it should have been at 8%. So transfer pricing will apply here. You have to increase it 12 into 6 into 200, 12,000. You have to increase your TTP by 12,000. Fifth one, transfer pricing does not apply. I wrote it there. Here it applies. Here they have to do this adjustment, but B, because UK resident, have to make equal and opposite adjustments to its TTP as it is a UK resident. It's the same thing. Thin capitalization, the new topic in ATX, which you have to learn. You might get a question on this, very high chance. Thin capitalization, when UK company pays a dividend, there is no tax relief for the payment. We know that. It is only on the interest, because interest is already tax deductible. That means you deduct interest from the expenses. That means you pay lower tax when you are having a higher interest. But for dividend, nothing like that. So this means company prefers debt over equity. Thin capitalization means to stop UK companies from getting excessive tax relief on interest. This occurs usually because they have received a loan from a related party that exists the loan. An independent lender would be prepared to lend. If you are taking from related party, it's very easy. Because of the relationship, you might take a bigger amount of loan and get excessive tax relief that you would have got if it was an independent lender. It's difficult to get from independent lender. We all know that, right? So this rule ensures that any interest on the part of the loan that an independent third party would be prepared to lend the company is allowable only. Only that much is allowable for tax relief. The excess is disallowed. So the borrowing capacity of the individual company and its subsidiary is considered, but not the rest of the group. Okay. Now, factors determining thin capitalization. HMRC will look at two areas to determine whether company is thinly capitalized or not. Gearing. Okay. Gearing means a relationship of debt to equity. Higher the debt, higher the gearing, and it's very risky also. In UK, 50-50 is ideal. Keep your debt 50, equity 50, equal. Higher portion of debt could cause thin capitalization problems. So you're having more debt than equity, it is thin capitalization. Next is interest cover. They will look. Interest cover is a ratio. We all know that. Okay. Ratio. This is how you calculate interest cover. Earnings before interest and tax divided by loan interest. So you see what is your earnings before you deduct your interest and tax to your amount of loan interest. If the ratio is high, okay, it's good. But if it's low, it's very risky. Okay, so your interest cover measures the risk, how risky the loan is for the lender. Many commercial lenders will look for the ratio of around 3:1. That means have earnings before interest and tax 3, loan interest should be 1. Every earnings and for every 3 earnings before interest and tax have 1 loan interest, 3:1. That's ideal. That means you are more likely to be able, you are in a financial position to pay back your loan interest with your earnings. That is the meaning of that. Now let us do question. Test your understanding 11. Advise ACCA PLC of how much loan interest they are likely to have relieved for tax purpose. Okay, so here he borrows 100,000. Market interest is 8%, and ACCA had to borrow from Barry as their UK bankers were not prepared to lend them more than 60,000. So here, because only 60,000 is allowed, so only the interest on 8% of 60,000 will be allowed, excess will be disallowed. So 8% of 60 will be allowed, which is 4,800. This will be allowed for tax. And interest on the excess, that is 8% on the 40,000, which is will be disallowed. $8% on 100,000. I'm sorry, it's 8% on 100,000, which is 8,000. So this will be disallowed because it is excess. Companies with investment business. Now, this is the last section of this lecture. So a company with investment business is a company whose business consists wholly or partly in making investments. This includes a company that makes and holds investments regardless of whether or not it carries on a trade. So the cost incurred by such a company in managing its investments are allowable when you are computing your corporation tax liability in accordance with the rules set out below. So the taxable total profit of a company with investment business are calculated in the same way as for a trading company. Same rules for the various sources of income and capital gains. For example, costs relevant to property business will be deducted from the property income. Now, management expenses. Management expenses are incurred in managing the company's investments, and this can be deducted from your total profit. Accordingly, expenses such as depreciation of office furniture would not be allowable, but capital allowances would be calculated and allowed instead, and business entertaining expenses would not be allowable. So these are the expenses which could have allowed as management expenses. Directors' fees and commissions, provided they are not excessive. Salaries of management, audit fees, office rent and raise, bank interest, excess management expenses can be carried forward and offset against total profit of future periods, and group relief if part of a 75% group. Now let us do one final question before we summarize this lecture. Test your understanding 12. Here you have to calculate the corporation liability. So you have been given the various types of income and expenses. Rental income, deposit account, interest receivable, chargeable gain, management expenses, property management and other, capital allowances related to property business and other, loan stock interest payable and directors remuneration. So now we'll calculate the property income. Property income, okay, there is a working that is required, working one. Then we have interest income. Interest income is simply the deposit minus the interest payables, 20 minus 2000. So it's 20,000 minus 2000, which is 18,000. Next we have chargeable gain. Chargeable gain is 3000. So as it is, we can take chargeable gain as 3000, and then we'll get what is known as our total profits. From our total profit we deduct management expenses. Remember, from total profit we deduct management expenses. Here there is a working 2 relating to this, and then we'll get our TTP. Remember, it's not on total profit, it's on TTP that we have to pay corporation tax. So first we'll do the working for property income. So property income, rental income comes under property. Then you deduct capital allowances because this is related to property, and management expenses 35,000 because this is also related to property. So working one, first is rent, 70,000. From here you deduct the capital allowances, which is for property, 2,300, and you deduct the property management expenses. Property management expenses of 35,000. Once you deduct, you get 32,700. So this 32,700 is your property income. Now you get your total profit, 53,700. Once you get 53,700, your management expenses, let us do working 2. So for we have this 60,000 manage expenses, then we have directors remuneration 3,000, so 60 and 3, and then we have the capital allowances, the other under management expenses, 1,600. So we add all the 3 and then we'll deduct our total profit from it. Remember, the excess management expenses are not allowed. So we'll add all this 3, 60 with this, so 60,000 plus 3,000 plus 1,600, we are getting 64,600 as management expenses. And if you see the total profit, it's up to 53,700. That means more than that you can't deduct, so this is restricted. You can only deduct 53,700. You can't deduct 64,600. So the excess management expenses were 10,900. So only up to 53,700 you can deduct as management expenses from total profit. And then we are left with TTP 0. So because TTP is 0, our corporation tax liability will be 0 as well. Okay. And what to do with this excess management expenses? This you can carry forward and you can have set against the total profit of the future period. Now, the summary of this lecture. So TTP computation, the gains, the new things are SSC exemption. That is, if you're having a shareholding of 10% or more, owning it for 12 months in last 6 years, it's a trading company, the disposal gain is exempt. Disposal loss is allowable. Interest. Trade, no adjustment. And if it's non-trade, it's an interest income. And thin capitalization. Only the interest on the part of the loan that an independent third party would lend you is allowable. Excess not allowable. Then transfer pricing. SMEs are excluded unless you are selling or buying to an overseas company in a non-qualifying territory. What are non-qualifying territory? Conditions has been given. Then large companies consider third-party values to whomever they sell. R&D, SMEs 86 plus 86% are allowable. That means total 186%. Then repayment is equals to 10% of the loss. Companies with investment business, allowable management expenses. Then excess management expense you can carry forward and or group relieved. Then we have intangibles for all except goodwill. Accounting entries are allowed if it's trading. You can claim 4% if no amortization, and goodwill, there is no allowable deductions for goodwill. That's it for this lecture now. It's all up to you to do questions. You have to look for questions on R&D, thin capitalization, then investment companies, intangible assets. So thank you, and I shall see you in the next lecture. That is also the continuation of corporation tax. So till now we have finished two lectures 17 and 18 on corporation tax. The third lecture 19, will also be the continuation of it. And don't forget to subscribe to my channel so that you get the notification when I upload my latest video. All these are applicable for your exam December 2024 and March 2025. Thank you for watching.